Welcome back to Callistofx, and today I'll be going deep into the theory of fair value gaps and how to identify them in the markets. There'll be two parts to this concept, so make sure you are subscribed and turn on the bell notification so you know when we post another banger video for you guys to learn from. So let's not waste any more time and dive into the concept. Alright, so what exactly is inefficiencies, right? They're basically gaps in the market, right? For example, over the weekend, you see price of gold suddenly jump up from, let's say, price 2000 to 2005 because of whatever news that happened in the market. Maybe uncertainty, the US dollar caused gold to pump by $5, right? Move $5 over the weekend. That could be something, maybe someone moved the market, right? Maybe Trump became president again. Who knows, right? There is one way of making the candles jump from one point to another point, right? Where there is an influx of orders, right? Where there's a lot of volume, right? Institutions are pumping money inside the market. This is when there is inefficiencies, right? Now, why are they important? Now, to move the market, right? Institutions would have to place huge orders to move price in its desired direction. However, it is inefficient to do so as a result, because it results in potential loss of the profits. Okay, the profits that they earn might be lost. That's why it results in some orders not being picked up by the market as price is moving too fast in a certain direction. Let me just give you an example, right? So for example, if you have price here of your oranges at $1, right? For example, you're at a supermarket. Currently, there's $1 per orange, right? And it stays this way until the point where there is not enough supply. So let me give you an example. Say the supermarket has 20 oranges, right? Me, personally myself, Nick, right, comes in and buy 10 of it. Now there's 10 oranges left, right? So Tom, Dick and Harry and 7 other people comes and buy the oranges at $1 each. So the price here stays the same until the point where the 11 persons want to buy. But there's no more stock. What would they do? They will bid for price to buy the orange from the people that owns the orange. So what will happen at this point? Personally, me as the shareholder, right, or the person that has the most number of oranges, right, I control the market price. So what price? So if I say, I should sell oranges at $2, right, what will price immediately do? Jump to $2 because that is where the next level of demand is, right? If I set my demand at $2, the oranges are going to be selling at $2, right? $2, right? $2 per orange. Now, obviously, not everyone is willing to buy at $2 per orange. So some people may say, okay, I'm not willing to buy $2. I'm going to wait for the price to come down lower. So what are they going to do? They're going to place bids. $1.10, $1.20, $1.30, 40 cents, so on and so forth, right? So at every single price point, there is going to be an order that hasn't been filled because of this sudden influx in the chart where price jumped from $1 to $2 because there was a lack of supply shortage, right? Supply shortage, right? Calm down. So because of this, right, price jumped. Right? Now, over a period of time, right, when there is fatigue in terms of price action, right, when price, they feel like, okay, cool, it's a bit too overbought. No one's going to start buying at $2 already. They want to wait for lower prices. So there's not enough demand there to buy, to keep price at $2 or go higher, right? So what will price do? Price will start to come down to collect the orders. This is essentially what inefficiency is, right? Right? Basically, what you have is an impulse from one point to another point. And when you have the impulse from one point to another point, right, you are expecting price to come down in a matter of time to fill these orders. This is what inefficiency is. Alright, so now what I'm going to do is I'm going to show you on the charts how to spot inefficiencies by looking at the candle bodies and the wicks. Right, so let's get into it. Alright, so how do we spot imbalance in the market, right? So there are essentially two scenarios over here. I've written them out very clearly in steps for you guys to understand and write down in your journal, in your notes, whatever. Just write it down, right? Because this is going to be very important in identifying how imbalance are formed, right? Or your fair value gap or your inefficiency, whatever you want to call it, right? So very simple. Firstly, we have the bearish imbalance. And you're looking right now at the first step, right? Identify the bearish candle that is big, right? Represents volume, right? That is high volume. So in this case here, the middle candle is the one where it's bigger than the other two, right? So this is the candle we first identify. So this is candle number 1, right? Now, next, what do you want to do? Identify the candle before and after that bearish volume candle. And this is 1 and 2, right? So once you have identified these two, right? Next thing you need to do is mark out the low of the first candle. In the bearish example, you want to mark out the low of the first candle like this. Mark it out. And then you have the, what did they say here? Mark out the candle high after the candle, right? You mark it out. Now, the difference between this and this is your fair value gap, right? Or whatever you want to call it. This is your imbalance, your inefficiency, your fair value gap. This is exactly where there are orders, right? They haven't been collected. And this is where price tends to fill in the future. Alright? So this is where how I would draw a bearish fair value gap. Now, for the bullish fair value gap, it's the opposite, right? Should be pretty straightforward, but I'm gonna say it again. Firstly, identify the bullish impulse candle, which is this one. Once you've identified the bullish impulse candle, look at the candle before, right? The candle before is here. And with this candle before, you have a wick, right? And with this wick over here, what you want to do is you want to draw and mark out the high of the candle, right? The next thing you do is look at the candle after the bullish impulsive candle. And you have it here. This is your bullish impulsive candle. And with that being said, my friends, this is your fair value gap, your imbalance or your inefficiency. This is how I mark it up, right? So it's pretty straightforward. It's just 3 candles, mark out your first impulsive bullish or bearish candle, look at the candle before and after and mark out the highs and lows accordingly to whether they are bullish or bearish. So these are 2 examples. I've written out all the steps already for you guys to take note. So please jot this down. Alright, so now next, what I'm going to be doing is I'm going to be looking at real chart examples and how to use them. Right, it's going to be a bit more conversational and you guys can understand my thought process as I'm looking at these fair value gaps. Alright, so looking at the current chart on gold, what we are currently looking at is on the 1 hour, we can see that price is coming up and coming down. Now, how do we identify the imbalance / fair value gap / inefficiency? It's pretty simple. We are looking for areas like, for example, in this case, there's this very impulsive candle over here. And then there's the third candle, right? So first step, what do? We look at the candle itself. This is our candle number 1. What is the next step? The next step is we look at the candle before. So this is the candle before. Where is the swing? Where is the candle high? Here. This is the candle high. We drag it out, right? Now, where is the candle low of the third candle? Because this is our next step, right? Mark out the candle low. This is our line. And where is the fair value gap? Right? Before all this price action happened, it is from here to here. And it is from here to here, and this is where price is retracing to. Right? As you can see, and we filled the imbalance. Right? Now, obviously how to use it, I will do it in part 2 of the video because I don't want the video to go too long. But essentially, this is how we identify a bullish fair value gap or bullish inefficiency. Now, how do we spot a bearish one? Very simple, right? You can see there is a very big candle over here, right? The first thing you see, oh look, oh shit, there's a very big bearish candle over here. What do I see? Right? I see 3 candles. Candle 1, candle 2, and candle 3. Now, how do I identify the bearish fair value gap? Simple. We do it like this. Draw it out like this, and the next candle, we want to draw it out like this. From here to here. So where is the fair value gap? From here to here. The top of the candle. And this is where your fair value gap is. Right? So there we go. This is exactly how you identify your fair value gap, and I hope you every single one of you guys here understand how a fair value gap is formed, right? And the reason behind it, right? The next video I'll be going through how to use it, right? How to use it in conjunction, right, with structure, because structure and fair value gaps works really well together, right, for you to understand how price can potentially, or where price can potentially go in the future, right? So stay tuned for that. But in the meantime, if you like the video and you feel that you have benefited from it, right, give us a like, right, comment down below what else you want to see, and most importantly, subscribe so that you understand and you know when we upload again. Right, I will see you guys in the next YouTube video. Ciao.